This is Business Weekend with Ross Greenwood.
Hi there and welcome to Business Weekend. I'm Ross Greenwood. It's great to have your company today and less than 4 weeks before the federal election. Coming up on the program today, Donald Trump's new tariffs smash financial markets and increase the risk of recession. But he says this is just the beginning of a new boom for America. Well, today we head to Asia where the tariffs will hit hardest to see whether the news is all bad in the short term.
How will the U.S. consumers react? How will the U.S. supply chain react? And of course, exporters in Asia and across the world. I think this shock is going to be a very difficult challenge to deal with.
Australian beef farmers are most exposed by these tariffs that will hit Australia, but the truth is America still needs Aussie beef. But farmers do face other difficulties, especially if a Labor Greens government is formed.
If there's a minority government with the Greens, the Teals and a myriad of independents, we need certainty in this country and regional Australia needs it more than anybody.
And in the wake of a big hack of Aussie super funds late this week, along with action and criticism of big industry funds by corporate regulator ASIC, some now wonder if the friendly industry of super funds, compare the pair, have simply become too big.
I think we've reached a point where super is too large. It's not well distributed. It's not meeting its target of taking more people off the Commonwealth pension.
Plus, a Business Weekend exclusive. We speak with the Chief Executive of Lamborghini, Stefan Winkelmann, on tariffs and why Lambo won't turn its back on Italy.
The key elements of a car manufacturer like Lamborghini is the made in Italy. No? So this is the exclusive business we are in, and this demands that we have solid roots.
But that's coming up. So let's start with the first Australian political response to Donald Trump's new tariffs, which was, this is no way to treat a friend. Look, in truth, Australia was treated way more leniently than other nations. From the stock market this week, the biggest impact was on companies that manufacture in Asia, but then export to America, taking advantage of its market. In those cases, the companies will be hit with the higher tariffs. Perhaps the biggest challenge is for Australian beef farmers, who also face the prospect of bans on the live cattle trade if a Labor Greens alliance is formed after the election. It's one of only many challenges for rural Australia, with devastating floods across outback Queensland right now that are twice the size of the state of Victoria. Well, a short time ago, I spoke with David Littleproud, leader of the National Party and the Shadow Minister for Agriculture.
Well, we shouldn't forget that we've also had tariffs imposed on our aluminium and steel sector as well previously. And if you look at what happened yesterday, Canada and Mexico didn't have a broad tariff imposed on them. They did in the car manufacturing sector. So what that does show and indicates is that there is hope for us to be able to get a further carve out if we can get a phone call, if we can get a meeting with President Trump. And I think that's important that we're able to engage quickly and build a relationship with President Trump, that he will deal and he will look at this in a pragmatic way. And I think Australia has a compelling case. After what we were able to do in the last couple of months, we dropped a cheque for $800 million on our first instalment for Virginia-class submarines. So we have a compelling case for a further carve-out. And I think it's important that we're able to have that relationship. But unfortunately, the Prime Minister hasn't been able to gain that phone call nor a visit. And I think it's probably time for a reset in terms of that relationship at a presidential and prime ministerial level.
So what you're saying to me is that a government led by Peter Dutton and by the coalition would have a better chance to get access to Donald Trump to argue its case. Is that broadly it, or do you sense that the relationship might be similar to what Anthony Albanese has now got?
No, well, I think there's no way in the world that President Trump's advisors aren't reminding President Trump of the disparaging personal comments that the Prime Minister and our ambassador in Washington have made about President Trump previously. And what we need to do is make sure that we give Australia every opportunity to be able to get further carve-outs and further concessions. We have that compelling case with the United States, and it's proven that his announcement this week shows that President Trump is prepared to listen and to be pragmatic. But if we can't even get a phone call, then we have challenges. And Prime Minister Dutton would be there within the first couple of months eyeballing, with respect, President Trump, not just for Australia. I think it's also a role for us to take a leadership role globally in reminding President Trump that the rules-based order of trade has served the United States and Australia, but the world well over time, and we should revert to that as quickly as possible.
So the grave fear at the moment is global recession. The prices rise in America, triggers a recession, which then reverberates around the world. Is that something that Australia, from an economic management point of view, has also got to be cognisant of?
Yeah, and this is inflationary. You can't look at this any other way, and we don't want to see a trade war, and no one benefits from that. And particularly when our larger trading partners in Asia are impacted by this, then they'll have an impact globally. I think in terms of agriculture, I think where the world can, it'll trade around the United States. And we saw that, in fact, last time when President Trump was last in power, he imposed tariffs on China. And in fact, the world pivoted away. And one of the key actions that we will take is to re-engage very quickly and bring together those trading partners in the comprehensive Trans-Pacific Partnership, to bring them together to make sure that we can pivot and access new markets of those 10 nations that are in there, to be able to work closely with them to be able to get greater market access, and then also obviously work through the EU free trade agreement. And we're not afraid to take the US to the WTO. We did it with Canada on wine, and China on barley and beef, and India on chickpeas. So we've got a record of this, and I think we need to respect the rules-based order, but you should also use the rules-based order and those rules within it through the WTO to make sure that we progress not just Australia's interest, but we set this straight, that we try and get the world back to a rules-based order.
So the free trade agreement with the European Union has gone nowhere. It's almost stuck at the moment. Do you get a sense that what's taking place with Donald Trump and tariffs opens a window for a renegotiation, a recommencement of those negotiations with Europe to get more Australian goods flowing that way?
Yeah, well, the world's changed, and here's the opportunity for us to lead. We've built those long relationships through CTPP, but the Labor government haven't been able to land the EU free trade agreement. There's an opportunity for us to re-engage. We don't want to trade away our sovereignty and some of the things that the EU wanted previously, but there is an opportunity for us to take advantage of this situation and to build some insulation into our economy and our trade aspect of our economy quickly. And I think that's a leading role that I support what the government's doing in the short term in terms of spending money in market access and trying to build that. But it's not necessarily just throwing money at it. It's leveraging our strong position globally to be able to leverage the free trade agreements we've got and to look to new ones. As the world shifts, we should shift with it, but we shouldn't walk away from the United States. We have a leadership role to play, not just for Australia, but globally, to get the world back to a rules-based order. The United States respects Australia, and we should leverage that position to lobby President Trump. But you first have to get him to pick the phone up or let us in the front door of the White House.
So just explain one thing. Given the polls and where they sit right now, it looks like there is a prospect of a Labor-Greens government, some sort of alliance after the election. Now, I know you're on the other side and you're still wanting a coalition government in its own right, but a Labor-Greens government would have big impacts for rural Australia and even for the sort of trade deals we might do in the future. What are your fears for that?
Well, obviously, they have an ideological view that doesn't believe in the production systems of our agricultural sector or our resource sector that underpins agriculture. We've got a live sheep industry that leads the world. And in fact, by us cutting and running, you'll see the perverse and horrific death of million sheep of countries like Sudan and South Africa and Ethiopia who take this market up, that don't have stocking density rates on boats. They simply throw as many sheep as they possibly can onto a boat and get paid with what's left at the other end. That's not a good animal welfare outcome. So us cutting and running will see a deterioration in animal welfare standards, but this then has a contagion impact onto the cattle sector, where the Greens have made it very clear that they don't believe in live animal exports. And this is a food security issue, not just for the Middle East, but for our good neighbours like Indonesia and Vietnam. And last election, Anthony Albanese did a preference deal with the Animal Justice Party to sell the live sheep industry out. And if he has to cut a deal with Adam Bandt, the Greens and the Teals, then our cattle industry is always at risk. And if you think about that, understand Northern Australia doesn't have a production system for processing. It's the grasses up there don't allow for that, and they don't have a grain sector to do feedlots. So live export is the only way. You rip away Northern Australia's future, and that's what I fear that will be the consequence of what will be political populism in the capital cities to win Green votes and support if there's a minority government with the Greens, the Teals, and a myriad of independents. We need certainty in this country, and regional Australia needs it more than anybody.
I just want to finish up and go to northern Queensland, and in particular the inland there, with a flood right now that is twice the size, the area of Victoria. I mean, it is immense, and it's not really getting the sort of traction in capital cities in the south that I think it probably should. But this is a real disaster, an ongoing challenge for many parts of rural Queensland.
Yeah, well, it's actually all through my electorate. My electorate is 3 times the state of Victoria, so 2/3 of my electorate's now underwater. Peter Dutton and I are out in Thargomindah on Monday, and I spoke to Tractor Ferguson, the mayor, out there yesterday, and there's only 5% of the town that's not underwater. They're all at the airport, and that's effectively what's left. But more broadly, we've seen probably 150 to 200,000 head in stock loss. That's going to have a serious impact on herd size and the economy out there. So it's important, and David Crucifulli has lent into this like he did with Cyclone Alfred. And the support should mirror what happened in the northwest Queensland floods in 2019. And he started that with $75,000 out the door straight away. And that gives mental support too, that people don't have to worry about the bills on their table. But we've also got to make sure that we look at this through a Western Queensland lens. We need, before we restock, to rebuild the dog exclusion fences. Otherwise, you restock and the wild dogs will just eat all the stock. So Premier Crucifulli's been very pragmatic about that. But I just say to every Australian, give us a month or so. Get in the car, even if you don't have a caravan, and come to Western Queensland. These towns are going to need your support, from Winton to Longreach, Thargo to Quilpie. Go and spend $1 out there in a month. We'll wash ourselves off and come out. That's the best thing you can do to support the towns. But our farmers, I have great confidence in the Premier and a bipartisan support at a federal level to get these primary producers back up on their feet.
David Littleproud, always good to chat to you, and many thanks for your time today.
Thanks for having me.
So with the announcement of this week's new US tariffs came a big fall in international stock markets and also in the oil price. And as well, the odds of a US recession, perhaps triggering a global recession, are now said to be higher. The chief economist of the world's biggest bank, JP Morgan, now puts the odds of that recession at 40%. But look, in truth, the tariffs will affect individual countries differently, depending on what they make and then where they send it and what their level of tariffs is. One person in a unique position to judge the effect across our region is Tai Hui, who is the chief market strategist with JP Morgan Asset Management based in Hong Kong, who joins me now. Tai, many thanks for your time. I mean, these are big falls in the markets. The markets always give a look forward to what, investors are expecting into the future. It clearly, short term at least, does not look good for the globe in regards to these US tariffs.
Absolutely. I think it's the breadth and also the magnitude of this tariff announcement that is shocking the market. I mean, put it in context, when President Trump came into the office on Jan 20th, the average tariff rates for US imports was around 2.5%. And after all the announcement that we've seen since April 2nd, that tariff rate is going to go from 2.5% to almost 25%. That's a huge jump. That brings us all the way back to the early 20th century. So I think the question then becomes, how will the US consumers react? How will the US supply chain react? And of course, exporters in Asia and across the world. I think this shock is going to be a very difficult challenge to deal with.
So we know in the Asia-Pacific region, it has become the manufacturing hub for most of the major Western companies. So therefore, it's no surprise to see in China, Western brands manufacturing, or in these days, Vietnam, or be it across the region. The point is now whether those businesses are really encouraged to go back to the United States or whether there is still efficiency in manufacturing in Asia.
Well, I think what you've seen, the evolution of supply chain in the past 10, 15 years is a lot of that obviously originated in China. And then because of the first Trump administration, the tariffs then, a lot of them moved to Vietnam, Indonesia, as you rightly said, and Mexico, et cetera, et cetera. But what you're seeing right now is that this tariff impact is not just against China, but really against a broad number of emerging markets and manufacturing sectors. So frankly, there's nowhere to hide. Now, back to your question, whether this could be relocated back to the US, I think there are challenges. Number one, obviously, the cost of labor in the US is much higher compared to any emerging markets that manufacturing is operating in right now. So either companies have to automate a lot of those processes, or they have to find ways to reestablish themselves. And frankly, that's going to take a number of years and billions of dollars of investment for any individual companies that look to bring manufacturing back to the US. And at the same time, if you look back to the tariff processes in the last few weeks or last few months, frankly, it's been a lot of stop-start, a lot of back and forth, and that type of stop-start, behavior, it makes it very difficult for companies to decide on what's their long-term strategy. So I think the reality is, I think some manufacturing could go back to the US, especially in areas like semiconductors, some of the high-tech manufacturing, where they do have good profit margin and ability to automate. But a lot of the more labor-intensive manufacturing, I think, is going to be quite difficult to relocate back to the US.
Okay, but then what happens if you can't relocate that manufacturing back to the US? Then prices rise, inflation rises, and the prospect of that global recession becomes greater, because markets right now are factoring in basically no inflation and falling interest rates, but the opposite could suddenly start to unwind.
Absolutely. I think it's not just about the risk of recession, so it's also the risk of inflation jumping back up to where we were, a couple of years ago. So the very scary stagflation phrase is now being thrown around a lot more than a few weeks ago. So I think that will put the Fed in a very difficult situation, because it's got one tool to deal with two opposite directions of challenges. And of course, when we talk about recessions, another question is, what could the US government do in terms of fiscal policy to offset some of that negative impact? Could they actually introduce more tax cuts or more spending in order to offset these impacts? Obviously, we've seen the Trump administration try to cut down on government spending, but they're also talking about cutting taxes too. So I think the risk of recession, whether it's 40% or higher or lower, it's not only about the tariff introduction, but also the reaction function of the US federal government, and that we may hear a little bit more in the weeks and months ahead. But at the moment, I think the risk is very much on the recession side.
But there's one other aspect that Donald Trump might be completely right. He might be able to drive investment back into the United States, which is what he's aiming with this. But the truth is, it takes time to build a semiconductor plant. It takes time to build, sort of some of the plants that he wants, vehicle manufacturing, whatever it is, it's going to take time. So this really, if it is to be successful, needs perhaps 2, 3, 4 years to actually really come to fruition.
Absolutely. Absolutely. I think if you look at some of the large manufacturers, whether it's TSMC from Taiwan investing in Arizona, or Apple, just an example, relocating some of their iPhone manufacturing to India, it's not something you can just do this in weeks or even a few months. It took them 3 or 4 years to build. In the case of TSMC, they are also trying to train local staff to be up to speed with the processes. And that, frankly, is taking a little bit longer than expected. So I think from those angles, if companies are willing to relocate some of their processes back to the US, the setup, the investment period is going to be in years, not months, and B, will they be able to find the right amount and the right quality of labor? I think that's going to be a huge question. So I think the idea is probably arguably correct from a voter's perspective. They want to bring jobs back to the US. But I think the reality is going to be a huge challenge for both corporate and the government trying to sort of wrestle back some of these manufacturing jobs back into the US, or even just broader developed economies.
So, Ty, one other risk that I see is really the disruption of global trade. If you've got suddenly containers and goods being shipped to America being diverted to other parts of the world because of those tariffs, that again almost replicates the conditions post-COVID when really you saw containers going all over the place. The price of freight went through the roof. I just worry and wonder whether that could be repeated again now.
I think so. I think the uncertainties of shipping routes and also the supply chain that could be disrupted. Of course, some governments may choose to offset these tariffs with their own fiscal policy in the short term, just to smooth things out. And of course, we're still waiting to hear from, for example, Europe and China and Japan on how they're going to react or how they deal with these new tariff proposals. For example, EU is talking about negotiation. Japan, I think they'll also go down a negotiation path. China may take a slightly harder stance. But clearly the risk for the second quarter and going to the second half of the year is that we could see supply chain disruptions. And as you already pointed out, the shipping freight rates and the supply chain costs in the transportation front could rise on the back of these disruptions.
Tira Tai Hui, the Chief Market Strategist with JP Morgan Asset Management based in Hong Kong. Thank you for your insights today. I genuinely appreciate it.
Thank you.
So let's now go to that stock market reaction to these tariffs. Look, it was swift and it was pretty ugly. In America, the worst one-day fall in 5 years. It's almost hard to remember that just 7 weeks ago, our market was at an all-time high. Yet since then, the market has fallen almost 11%. Virtually nothing is immune. At times like this, only the brave, the foolhardy and the very well-informed are wading into the market to buy, or people like Anton Tagliaferro, founder of funds manager Investors Mutual, a noted value-seeking investment manager. He's with me now. Anton, thanks for your time.
Thank you, Ross.
Are you wading in or not?
I'm buying a few things, yes, on the back foot, defensive stocks, which, the tariffs have come in. We still don't know the economic repercussions. We don't know if the tariffs are going to be final anyway, or whether it's a first ambit. Secondly, we don't know the economic repercussions, and then, of course, the earnings repercussions. So we're kind of still very early,
It isn't one of the big issues. We look at this and we look at, Australian companies that seem to be hit hardest are those that manufacture in Asia, so cheap manufacturing, that are going to get hit with big tariffs, and then they're sending those goods to America. So you get some sense that Donald Trump is saying, well, you can't really take the mickey out of us as a manufacturing nation and expect us to do away with this forever.
Well, in Australia, if you look at Ansell, for example, which produces gloves, etc., in Asia, and then it takes them to the US and sells them there, they've been hit quite hard. But apart from that, I think really since COVID, we've had a market where, almost the higher the risk of the stock, the higher the valuation.
Yes.
And obviously we've had a boom on the NASDAQ, and we don't have a big technology sector here. So we've seen also, I call them the specs, companies with very little revenue, let alone profit, that have been going up in multiples. And you look at some of the valuations of those, and they're at 1 billion or 2 billion, they've hardly got any sales. So that's another sector, which obviously the air is being deflated from there.
Yeah, sure. But there are a lot of companies, Australian companies, that have deliberately gone to the United States. And here I'm thinking of the likes of James Hardie. I'm thinking of BlueScope Steel, Brickworks. There's obviously CSL is very big there. You've got ResMed is big there.
Yeah.
There's a range of companies.
Yeah.
Amcor is massive there, right? So the question is whether those companies already having operating plants in America are somewhat immune from these tariffs.
They are somewhat immune to the tariffs, but then again, there's a question mark over what is all this going to do to US economic growth. So number one, you've got obviously the equity risk premium. The market valuations depends on how confident people are in the future. There's a lot of uncertainty. So what tends to happen is the PEs contract.
Yes.
Okay. And secondly, what we don't know is the economic repercussions. A lot of people are talking now about a recession in the US. If you look at, I was reading this morning, there's like almost 300,000 people made unemployed because of DOGE.
Yes.
In terms of public servants. Clearly, I think as we discussed last time, if you're a company financial controller deciding, shall I build a new plant? Shall I import some steel? Shall I bring the cars in this week or to sell them to next week? I would have thought a lot of those decisions are on hold at the moment.
So, because one of the things...
Which is going to impact economic activity.
That's right. So here's the point that you're making, is even though share prices have come down and valuations may right now look attractive, What you don't really know is how far profits in the future may come down, because what looks attractive today, if profits start falling even further, might not look quite so attractive in 6 or 12 months' time.
That's right. And again, bearing in mind, a lot of the upside, you know, in markets the last few years has been in the more speculative, growthy things. Yes. Okay, so a lot of very, I call them almost basic, boring companies haven't really re-rated that much. So they're not, in my opinion, they're not very expensive. And maybe that's the next. I mean, if you look, for example, today, a small example, you know, Coles has gone up. Like, why? Well, because it's stable, because of the dividend, because whatever, right? So a lot of those companies really haven't done much in terms of share price. And I'm not saying Coles is the buy, but they haven't done much in the last 2 or 3 years, right? While all the fun and games have been going on with the Nasdaq and all our little specky things, and Pro Medica's going to P of 300 at $280 a share, and while all that's been going up, a lot of my holdings, actually, they've paid dividends and done okay, but they haven't really participated in that upside, because, you know, the dividends it's almost been boring to get dividends.
Okay, so take me to one sector that has led Australia's stock market to its all-time record, and that is banking, and in particular the Commonwealth Bank. Around the world, one of the grave concerns will be, if there's recession, that they become more conservative in who they will lend their money to. If there's a big downturn coming, asset values are falling, banks traditionally get very conservative. If that's the issue, then the earnings of banks suddenly start to come into question as well.
That's a fair point, although the banks have really stuck to residential. You know, if you look at the last 5-10 years since the GFC and APRA changed the capital rules, they've really focused. So they got out of car leasing, they got out of development. So a lot of that's gone into the private credit market, you know, which is now 200 billion in size in Australia. So that, you know, a lot of those sort of riskier loans, I think, would be in the private credit fund. So the banks, the main issue is, look, they're very solid, whatever, etc. But it's just the valuations. You know, they're trading on 20-odd times. There's not a lot of earnings growth, whatever. So there's no real earnings risk from the bad debts unless we get a housing correction, because that's where the banks are now mainly exposed.
So tell me, right now, sitting here talking to me, would you prefer to have money in the bank at 4 to 5%? Or would you prefer to have a dividend yield from an Australian company paying 3 to 5%?
Well, again, depends on what the Australian company is, and depends where you're going to put your money. If your money's going to into a
bank, say?
Into a bank, it's no problem. At least it's safe, unlike these other things which I was talking about. You know, in terms of stocks, you know, I've always been a believer. If you can have a portfolio of good, solid, stable, you know, companies whose fortunes and profits don't depend so much on the economic activity, which are reasonably priced, you know, that's where I...
So what you're saying is...
always tended to put my money.
A person with that portfolio has woefully underperformed over the past 4 years.
Well, and he's doing very well now compared to... I look at my portfolio every day and it's hard to see where it's falling, to be honest, and I'm not trying to boast. But, you know, a lot of these companies, like your Horizons, like your Region Shopping Centre, etc., you know, Telstra, they haven't really done that much as a group, Sonic Healthcare, etc., in the last 3 to 5 years compared to many of these other high-flying stocks. And many of those stocks have been sort of neglected because they're boring. They pay dividends, they're growing slowly, you know. And now in this correction, which is really hitting the more... I mean, if you look at the US, it's the Nasdaq, right, which is coming down the quickest. So that's where the correction's really hurting. So people who've been exposed to these high growth stocks, mentioned Pro Medicus, you know, on a P of 280 or something a few weeks ago. It's not on a P of 200, by the way. But anyway, you know, those sort of stocks, they've been, you know... Ross, when markets are bullish, you know, blue sky gets valued almost to infinity, right? When reality hits, like now there's a correction or nervousness, that blue sky can sort of diminish pretty quickly. And that's what we're seeing now.
I tell you what, always great to have you in the program. Anton Tagliaferro, many thanks for your time.
Thank you.
Coming up after the break, are big superannuation funds in Australia too big? The corporate regulator ASIC is calling them out for failing to properly look after their customers. And late this week, a shock that hackers stole money from investors in some of our biggest funds. Our guest, funds management veteran John Abernathy, thinks they've become too big to manage. Thanks for being with us here on Business Weekend. Well, Australia's $4.2 trillion superannuation system is seen to be world leading. It's one of the biggest retirement pools in the world. And as of July 1 this year, contributions from workers' pay will rise to 12%, which long ago was set as a benchmark for workers to become self-sufficient in their retirement. But as industry super funds, Australian Super, Cbus, Hester and others have grown to enormous sizes, there's also criticism about their performance. And recently, the corporate regulator ASIC has taken legal action against Australian Super and Cbus for their poor performance in handling death and disability claims. Here's ASIC Chair Joe Longo speaking this week.
Super funds need to do better when it comes to the handling of death benefit claims. Grieving Australians should not have to suffer stress and in some cases financial hardship because of their failures. All Australians have an entirely reasonable expectation that super trustees will be there to assist them and provide their services in an efficient, effective and compassionate way. Meeting this expectation is even more important after a life-changing and traumatic event such as dealing with the death of a loved one. The fact we are seeing repeated failures across the sector in the handling of death benefit claims is, frankly, a sad situation that must be addressed.
And late this week, another scandal. Some of the country's biggest funds, including Australian Super, Australian Retirement Trust and Rest, have admitted hackers stole passwords to long-term members' accounts. Small sums had been stolen, some of the funds said. Now, this only adds fuel to the fierce criticism that big super funds have become too big. One of those is the founder and chairman of the boutique investment house, Climb Investment Management, John Abernathy. And I spoke with him late this week.
Well, it's world leading in size. I think we're heading towards the second largest pension scheme in the world in about 10 years' time, which is a remarkable achievement for today 26, 27 million people to be only second to America in a decade's time. That would be extraordinary given the world will have over 8 billion people in it. So it's outsized. Is it world leading? I don't know, but it's certainly big.
So does it actually deliver enough benefit to the Australian community? It was originally put in place. Paul Keating's vision was to take the pressure off government providing age pensions with the baby boomers coming through our system. Is it actually living up to that aspiration?
Well, it's hard to say that's so at this stage. You know, we've been going a long time and we're still seeing 70% of retirees claiming a full or part pension when they retire. So that's hardly a measure of success. Now, success would look like an overwhelming minority of people retiring would draw upon the Commonwealth pension. So we're a long way from that, and I don't think it's likely to get, say, under 50% in the next 15 or 20 years. So it's not working. The account-based system has a flaw in it because there needed probably to be a basic national pension scheme which everyone contributes to and everyone draws upon, but just having an account-based system has created problems. And the other issue is the size of it. I mean, it's wonderful to talk about 4 trillion assets, it's wonderful to talk about 8 trillion in 10 years' time, but what's going to be the distribution of that capital and how many people is it going to support off the Commonwealth pension? And the figures just don't support it. And then the final comment is the more money you put into super, then you have mediocre returns developing because the investment managers have to default to index type investing, not only inside markets or asset classes, but around the world. And the big default today is into America.
So that being the case, and given that private equity, private credit markets are now being dominated by these big industry super funds, I'm wondering whether you worry about that as well, because of course the more that superannuation funds invest into illiquid private markets, the less flexibility they have if there's ever a sharp downturn in asset prices.
Look, the valuation of investments, you know, away from the stock market and the bond markets and maybe the corporate debt market, but when you get into private equity, private infrastructure, some strange assets, you know, timber, and so to speak, I mean, the valuation is really arguably artificial. It's just an opinion. And the more money, as you say, goes into that, then the valuation of super itself becomes more significant.
What about the liquidity of these super funds? At the moment, if somebody wants to retire and get their money, well, it comes out of the contributions that others are making. In the future, are there so many people retiring that they basically either have to liquidise or change the policy to hold the members' money in there during their retirement years? It seems that's where they're going with, in particular, allocated annuities.
Yeah, it's a big question, and there's a lot of smokes and mirrors, and I don't know whether we really know what's actually happening inside these big industry funds. At this stage, the inflows are more than adequate to meet the outflows. And to some extent, that allows the fund managers, the asset managers, to allocate to illiquid assets, so long as those flows continue. And that's probably one of the reasons, unspoken reasons, why we keep on lifting the contribution rate towards 12%, as you say, in July 1. It doesn't seem to be a lot of logic to 12%. It's a number plucked out of the year, and I don't think there's a lot of research done on it, whether that's actually good or bad. But the money coming in meets the money going out. If there's more money coming in, that's great for pensions. But as you say, as we age, then there will be a switch and there'll be more money coming out than going in. Again, maybe that's offset by economic policy with having large immigration policies. So we keep on almost printing people to join the superannuation system in Australia to be contributors to meet the challenge of pensions. I just query whether there's a lot of thought process going on, whether there is a grand plan. It's certainly not public. It's certainly not something I'm here speculating, because I don't actually have a document which I can refer to, which is the grand plan for Australian super. We set it up a long time ago. Great concept. It's more, we are past time for a rethink, a pause, and probably a reset.
So, one final question. I'm old enough to remember the days when Australia's retirement system was dominated by AMP, National Mutual, Colonial Mutual, MLC. At some point, they all got so big that they needed themselves to raise capital and often to float on the stock market. Do you see a day when Australian Super, Cbus, Hester and others have to do the same thing?
Well, yeah, well, I worked for NRMA and we floated on the stock market. We certainly didn't need capital, but we went in super and general insurance. We had a very good business. I think some of the companies you mentioned, it was poor management policy, poor business. I don't think they got too big, so to speak. They just were poorly managed and didn't control their growth. So let's just leave it at that. Will these super funds float on the stock market? Well, it'd only be to raise reserves in case of issues of liquidity, as we said earlier, on pensions, or massive claims for malpractice or poor performance or poor delivery of services. You know, we're seeing the fines come thick and fast. It's not clear who actually pays these fines. Is it the members? Is it insurance? What's going on here? Directly to your point, I can't really answer it. Does it make sense that it could be the management company is listed on the stock market, the management company with a fee, but then you turn it into a profit organisation, and do you lose the purpose of what super was supposed to be? I go back to my point. I think we've reached a point where super is too large. It's not well distributed. It's not meeting its target of taking more people off the Commonwealth pension. And we're seeing more and more default in a period of worldwide uncertainty, given what Trump is doing with tariffs. Australia industry funds are defaulting into the American economy. And if they can see clearly what's going to happen in this trade situation, I'd have to give it to them. I think they're buying America because they got nowhere else to put it and they got too much money coming in. That's not a good answer. I know I'm ducking and weaving on your question. Refloating it, possibly, but I have to think about how it's structured and why.
Tell you what, John Abernathy, always great to chat to you. It certainly is a challenge for superannuation funds, and I appreciate your time.
Thanks.
After the break, the election is coming, but housing policies, well, they're fairly scarce. Plus, a Business Weekend exclusive, the Chief Executive of Lamborghini, Stefan Winkelmann. Thanks for being with us here on Business Weekend. Well, the government set aside $33 billion over 10 years, mainly through extra funding for the Help to Buy scheme to help home building. But look, home building stats show it's still way behind its target of 1.2 million new homes by the end of the decade. Edward Boyd investigates.
Cost of living is the major issue for voters at this election, and the biggest cost of all is housing. Affordability is at record lows and rents are close to record highs. Labor, the Coalition and the Greens have all proposed various solutions to these problems.
Housing is critical at this election. We're going to be holding all the parties to account on what they're doing around housing policy.
Labor will expand the eligibility requirements for its Help to Buy scheme, allowing people with slightly higher incomes to access the shared equity scheme, where the government becomes a part owner in their property. It's also set aside $33 billion in the recent federal budget for housing.
Thank you. How are you?
Meanwhile, the Coalition want APRA to reduce its home loan serviceability buffer from 3% to increase borrowing power. They will also allow first home buyers to access up to $50,000 of their super to buy a home. The Coalition have also pledged $5 billion to build essential infrastructure at housing development sites.
Look, the reality of a lot of these promises by both Labor and the Coalition is that I don't think they're going to dramatically shift the dial. When we look at things like Help to Buy scheme, there aren't that many places announced. And then if we look at the Coalition's plan to let people access their super, typically people don't necessarily have enough in their super if they're in that first home buyer cohort. So while it's good to see the focus is on housing and helping people get into the housing market, the reality is it's still going to be really tough out there, even with these policies.
Some experts believe APRA's serviceability buffer is preventing Aussies from entering the housing market. CanStar says an Aussie on the average wage of $103,000 a year would be able to borrow an extra $20,000 if the buffer was reduced to 2.5%.
So the current schemes that are in place, like the Help to Buy and the Homeowners Guarantee Scheme, actually are very targeted programs. And I think to support more first home buyers into the market, we need to look at every option that we have. The serviceability buffer has been 3% for quite some time, but it was as low as 2% in 2014. And so I do think that we need to look at whether that buffer is still at the right level, and in order to actually maybe ease pressures and give some more people opportunities to purchase their homes.
Labor also want to provide more financial support directly to apprentices to stimulate the construction sector. Meanwhile, the Coalition will provide support directly to employers who are hiring the apprentices. But a major concern for the housing sector is the proposal by the Greens to phase out negative gearing, a policy that Bill Shorten attempted at the 2019 election, which he lost to Scott Morrison.
We've got concerns with any crossbenchers, whether it's the Greens or I know some of the Teals are also concerned about negative gearing, in making policy demands that are totally contrary to increasing supply of homes. And if we look at negative gearing and capital gains tax changes as being proposed by the Greens, the answer to that is simple. If you make changes to negative gearing and capital gains tax as it currently is, you reduce the supply of homes because you've reduced the number of investors into the rental market. It is actually an own goal to think that those changes are going to improve the rental market. They are not. It's only going to get worse. So we would say if there is a minority government, both major parties will be held to account by master builders if they are doing any deals that is contrary to the national interest.
Anne Flaherty from REA Group says removing negative gearing would have serious implications for renters.
Ultimately, the biggest losers from this kind of a policy are going to be renters, because what this does is dramatically discourage investment in property. We need a healthy balance between owner-occupiers and investors in the market because, of course, a third of Australians rent. Now, if we take Victoria as an example, there's been so many investors selling off that the actual total number of rental properties has shrunk by over 20,000.
Look, and to finish up now, a little something special. This week, Fox Sports reporter Matt Sulo gained exclusive access to speak with the chief executive of Automobili Lamborghini. Stefan Winkelmann, who's visiting Australia and its high net worth customers who can afford new car prices between $418,000 and close to $1 million. So he explains why, tariffs or no tariffs, Lambo will never turn its back on Italy.
But now we have heard this morning about the tariffs. We are working on different scenarios and we will announce our decision pretty soon.
Could you ever see a scenario where Lamborghini begins to manufacture your cars in America?
No, one of the key elements of a car manufacturer like Lamborghini is the made in Italy. No, so this is the exclusive business we are in, and this demands that we have solid roots and the history in the land where this company was founded, and therefore we will remain in Italy.
Do you think your customers in the United States are going to care about that 25% increase, or how will that impact them?
For sure, it's not going to be easy. It's too early now to make an estimate on how this is going to end up in terms of sales. We will wait and see.
All right, you've launched the Temerario here right in Australia, this beautiful car. What can you tell me about it?
It's an all-new car, no? So it's the first plug-in hybrid in this category for us. It's a car which is completely new in terms of design, but also in terms of chassis. The engine is really a pearl because it's a V8 biturbo, which is revving up to 10,000 RPM, and this is something which is extraordinary also in our environment.
Now, last year you posted record sales. How do you see the luxury market performing, not just this year, but going forward as well?
If we speak about Australia, we are very stable with an increasing interest in the brand. And this is very good. We are always looking for controlled growth, long order bank, and very good residual values of the car. And this so far has worked out. And now with all the lineup renewed, I think that this is going to be the next step for Lamborghini.
Well, how important exactly is the Australian market to Lamborghini?
It's a very important market. So we have a very balanced distribution in the three major regions, the Americas, Europe, Middle East, and Africa, and Asia Pacific. And it's in the top 10, the Australian market, and it's still rising. So this is a good sign for us and also for the customers here.
Now, you have mentioned that in the future, Lamborghini will bring out an all-electric sports car. How do you retain the DNA that is Lamborghini with that car?
For us, it's all about design and performance. Design is clear. It has to be very recognizable, but also very different from one generation to the next one. In terms of performance, there are two ways of looking into it. One are the pure numbers, and the other thing is how you feel the car, the emotion, the feedback the car is giving you. And this is something we have to work on for our first electric car, which will be coming at the end of this decade. So we have time. I think that with software, but also with a power-to-weight ratio, this is achievable. We will have a new body style doing it, so it will be an add-on model. And with the rest of the lineup, we will continue with plug-in hybrids.
And that's it for the program this Sunday. Up next, all the latest news right here on Sky News. Business Weekend returns next Sunday, but of course you can keep up to date with the latest business news with our daily program, Business Now, 4:30 p.m. Eastern Time. Thanks for your company today. I'm Ross Greenwood. We'll see you next week.